This is where post 302 gets real. Closing content is not just vocabulary. You must understand the timeline, the documents involved, and the broker's responsibilities. And yes, you're going to have to do some math. Let's begin with the difference between settlement and closing. They are not the same. Settlement is when the documents and funds necessary to complete the transaction are delivered to the settlement agent. Closing is defined in Standard Form 2T as recording of the deed. That difference matters. Possession is delivered at closing. That's after the deed is recorded, not at settlement. Now, pre-closing duties include the buyer selecting a settlement agent, and they need to do it early. In North Carolina, that is usually going to be the closing attorney. Brokers should help provide the settlement agent with the offer to purchase and contract, any addenda or amendments, the payoff information they have, any homeowner association information, invoices, and anything needed to prepare the closing documents. Earnest money may be transferred to the settlement agent no earlier than 10 days before the scheduled settlement. Now, TRID and RESPA. Let's focus on RESPA. RESPA applies to federally related residential mortgage loans for 1 to 4 family dwelling units. It is designed to protect the consumers from abusive settlement practices and improper referral fees. Kickbacks and referral fees for settlement services are strictly prohibited. Broker-to-broker referral fees for brokerage activities are allowed, but no other referral fees. Now, TRID requires the borrower's closing disclosure to be delivered at least 3 business days before settlement. And 3 things can trigger a new 3-day waiting period. If the APR increases, a change in the loan product occurs, or the addition of any prepayment penalties. Now, the settlement statement is part of it. This is the part you love to avoid, and that's exactly why you need to practice it. No credits and debits. Remember, a credit helps that party. It's money they receive. A debit is something they must pay. Typical buyer debits include attorney fees, loan fees, the appraisal, inspections, title insurance, recording fees because the buyer records, interim interest, and any lender escrow deposits. Typical seller debits include the commission, deed preparation, excise tax, loan payoffs, and any seller concessions. Prorations are divided between the buyer and the seller based on who owns the property for that period of time. In North Carolina, unless the contract says otherwise, the seller is always going to be responsible for the day of settlement. That means the seller pays for the day of settlement. They pay the taxes, and they keep the rental income for that day. Here's the pass the test strategy for settlement statements. Do not try to do the whole problem at once. Go line by line. Ask yourself, does the buyer pay for this, or does the seller pay for this? Or does one or the other of them or both get a credit? Paid before closing or paid at closing? Prorated or not prorated? The contract term or the closing cost? This course may feel heavy, but it is passable when you study it as a transaction from offer to closing. Control the process, control the documents, control the math, and go pass that test.